Okay, we now have 29 students. Okay, let's start with by introducing the option pricing paper, which is uploaded in the YSEC. So if you have not downloaded your paper, so go to the YSEC, and there is a section called CRR. That CRR represents the three authors of this paper. So the first one is Cox, the second person is Ross, and the third one is Rubinstein. So usually we call this paper by using the first letters of the three authors. So it's called CRR model. The title of this paper is Option Pricing, a Simplified Approach, and it is published in 1979. So it's pretty old, but but this is one of the classic in option pricing theory. So I'm gonna go over the first part with you one by one, and then certainly at some point in time, I'm going into the mathematical things. But actually, you don't have to worry about too much because we already know all the details of the mathematics, which we are going to use today for this paper. So the first paragraph of this introduction is just an explanation of what option is. So an option is a security which gives its owner the right to trade in a fixed number of shares of a specified common stock at a fixed price at any time on or before a given date. So now I believe that most of you can understand what it means, but I just want to make one point on this sentence. So at the end of the sentence, it says, at any time on or before a given date. And it needs an explanation. Because the authors wanted to talk about the options, but what we know about the option is just one type of option. Of course, there are two types of options. The one is the call option, the other one is the put option, but we can classify options in different ways. So I'm gonna use the whiteboard. So we know that the call option and put option, these two are different options. But there is another way to classify options, which is defined by two different terms. So first one is the American option, and the other one is, am I right? It's, yeah, European options. So that I was talking about usually what I was talking about the options, I always refer to the European option, not the American options. The difference between these two options, the difference is that they all have the same maturity. So it has the maturity at T, and the European option also has a maturity at T. But for the European options, you can only exercise your option on the maturity date. That's why that's not the reason, but this kind of option is called a European option. In contrary, the American option is you can exercise your option on maturity date, but you can also, if you want, you can exercise your option at any time before the maturity date. So that's the difference between these two types of options. Of course, there are American call option and there is an American put option, and also European call option and European put option. So the difference is that when we can exercise the option makes these differences. So one is called the American option, the other one is called the European option. But here I'm mostly talking about the European options, but the author of the paper wanted to discuss these two different kinds of options altogether. So they use the word, so go back to the paper, they use the word at any time on or before a given date. So if they just wanted to talk about the European option, then they might say uh, at a fixed price on a given date. But they also wanted to talk about the European option. So they, uh, instead of saying that on a given date, they use the word at any time on or before a given date. So that's the difference. So, but basically, this paper wanted to talk about the both of them, but I just want to make a focus on the European options. So when you read this paper, you will be you will encounter some paragraphs that you cannot understand from the viewpoint of the European options. Then just ignore that part, and that's okay. So we are not going to talk about the American options. And the next sentence says the act of making this transaction is referred to as exercising the option. So exercising the option. For the European options, you can exercise on a given date only. But for the American options, you can exercise your option at any time you want once you have one. So that's the difference. The fixed price is termed the striking price. So the fixed price is the price that I promised to buy or the price that I promised to sell is called the striking price. And the given date is the maturity date. And so it has a different name, the same thing, but we call it with different terms. So sometimes we call it a termination date, or sometimes we call it the expiration date, and so on. And then the call option gives the right to buy the share, and a put option gives the right to share the share. So we know the difference. The call option is a right to buy the underlying asset, and the put option is the right to sell the underlying asset. And in this paper, the authors think that the shares is the only underlying assets, but you can apply the same thing to other underlying assets like the interest rate or the exchange rate. But usually the option was traded for the shares traditionally, so they focused on the shares, but you can also apply the same technique to all different kinds of options. And options have been traded for centuries, but they remained relatively obscure financial instruments until the introduction of a listed options exchange in 1973. And they said, yeah, option has a very long history, but usually the usual people did not know the options, but it it came to the word in 1973 by the introduction of the real exchange market for the options, the official the markets in the United States. And that year happens to be 1973. And strangely enough, that 1973 is also a very important year in the pricing of the options. So the next paragraph says option pricing theory. So this is not about the trading the option, it's about the theory on how to value the options, how to make the price of the options. Has also a long and illustrious history, but it also underwent a revolutionary change in 1973. At that time, Fisher Black is the first one, the Fisher Black and Myron Scholes. So these two people present the first completely satisfactory equilibrium option pricing models. And model is usually called the Black-Scholes model. And it was published in 1973, happens to be. And in the same year, the Robert Martin extended their model in several important ways. And Robert Martin is another contributor to the option pricing theory, but since he did not involved in the Black-Scholes paper, so Black and Scholes, they together write a paper, and then Merton write another paper based on the Black-Scholes model. But actually the Black-Scholes model, the mathematics used in the Black-Scholes model is heavily depend on the Robert Merton's paper. And actually, they are all colleagues in the MIT at that time. So the Fisher Black was, as I know of, consultant in the MIT at that time. And Myron Scholes is an assistant professor. So the very beginning year of the professor in MIT economics department. And Robert Merton, actually he was a PhD student in MIT, and they knew each other. And for some reason, Black and Scholes wrote a paper together, and Merton wrote a separate paper. And later, these three people, but actually only two, the Scholes and Merton, got the Nobel Prize, and the Black did not get it because he died before the Nobel Prize. And the importance of their discovery is that, as these studies have shown, option pricing theory is relevant to almost every area of finance. So this is what I wanted to point out several times. So if you know the basic option pricing theory, and you actually can cover almost every area of the finance. So for example, virtually all corporate securities can be interpreted as portfolios of puts and calls on the assets of the firm. So indeed, the theory applies to very general class of economic problems. So you can actually explain almost everything in finance. But the problem is here, unfortunately, the mathematical tools employed in the Black-Scholes and Merton's article are quite advanced and have tended to obscure the underlying economics. And their model is use a lot of advanced mathematics, so-called Brownian motion, Ito calculus, and all kinds of things. But the reason why I'm talking about this paper is that the author, the CRR paper, skip all those advanced mathematics, and they just use some elementary mathematics. So they said that it is possible to derive the same result using only elementary mathematics. So I'm gonna use their elementary mathematics, but as you read on, you can realize that this is not just elementary. It's at the end of the paper, it's quite advanced, but up to the middle of the paper, and it is actually elementary. You can only need some plus and minus, multiplication, division, and some log and exponential, that kind of thing is enough. So in this paper, the CRR will present a simple discrete time option pricing formula, and the fundamental economic principle of option pricing by arbitrage method is particularly in this clear. So that is the end of the introduction of this paper. And then later they said the next chapter, the next sections explains it, this kind of thing and this kind of things. So we are moving on to the section 2, the basic idea. And I don't think you have any questions for the introductions. So I just, skip the Q&A session, and then I just go to the basic idea. So just think about the numbers in this section. So suppose the current price of a stock is $50, and at the end of a period time, its price must be either $25 or $100. So right now it's $50, but at the end of the one period, which means when we toss a coin, it can be either $100 or $25. So it depends on the coin tossing. And then a call on the stock is available with a strike price of 50. So let's suppose that we have an option, a call option, and that call option has a strike price of K, and K Jay just said that the K is 50. So before I move on, just think about the payoff of this call option. So everyone remembers the payoff of the call option, and it was max st minus k comma 0. So this is the payoff of the call option, and remember that this is the payoff at the maturity time. So here is t. So if I draw the current situation with the numbers, so we can say that the current stock price is 50, and then it can goes to 100, or it can goes down to $25. And then you have an option here. And then that option price also can go up or down depending on the outcome of the stock price, because this is the maturity of the option. This is the maturity date of the option. And according to this payoff, it is just max ST. But what is the ST here? The ST is this one, right? Because assuming the coin shows a head, that means the stock price shows you a head. So that means it's $100 minus, and K, we assume that K is 50. So it's 50, comma 0. So that is the payoff on the upstate. And then payoff of the downstate is basically to use the same formula. So max, and then the ST in this case is 25 because it's in the downstate. So it's 25 minus 50, comma 0. And as you can see, this is the negative number. So basically, C turns out to be 0 here. Now go back to the paper again. So the first two sentences tells that the first sentence is talking about the game of a stock, and the second sentence says there is a call option depending whose underlying asset is the mentioned the stock price. And then we need one more thing. It is also possible to borrow and lend at a 25% rate of interest. And you may think that 25% is too big, but that number is just for the convenience of the calculations. So what I mean by convenience is that now we have the first game and we have the second game, but in our terminology, in our example, the first game is here, and it should start with 1, and it says the interest rate is 25%. So 25% is a quarter. So it's basically 1.25 here. It's 1.25. So if you put $1 in the bank, at the end of the one period, you will get 1.25, and at the end of one period in the downstate, you will get this number. And if you borrow $1 from a bank, then you have to pay back 1.25 and then 1.25. So we already know how to price these things. So this is the first game, and this is our second game. And this is the third game we are interested in. So for this game, we want to find the value of the C using, say, replication or arrow-driven securities or risk-neutral valuations. And we already know how to do that. But in this paper, we can go directly to the applying the method we learned, but they explained it in a little bit different ways, but the answer will be the same. So let's just follow their explanations. So here, okay, so it is also possible to borrow and lend. So the only one piece of information left unfurnished is the current value of the call C. So we know the current value of the C, but all the other 8 numbers. So here altogether 9 numbers. The first 3 number is for the bank. The second 3 number is for the stock. And then in the final third game, we don't know the current price of the stock, but we know the upstate value and we know the downstate value. So the only information left unfurnished is the current price of the call. And they said, however, if riskless profitable arbitrage is not possible, so you know the meaning of the arbitrage. So by assuming that there is no arbitrage, we can deduce from the given information alone what the value of the call must be. So if you assume that there is no such a riskless profitable arbitrage, then with all these 8 numbers, we can always find the only one unfurnished information, and that number must be the value we are going to calculate. So in order to explain this situation, the authors write 3, where is, okay, 3 different things. So, well, for some reason I cannot select this part, but in the box, they said 3 things. So let's just read one by one. So write 3 calls at C each. Here, the write is the old terminology, and that means you are in a short position. So write means sell the call options. And we don't know the current value of the call option, but let's just make a portfolio, take the short position of 3 calls. That's the number 1. And the number 2 is to buy 2 shares at $50 each. So we know that the current price of the stock is 50, and we are going to buy 2 shares of the current stock. And then the third one is borrow $40 from the bank at 25 interest rate, and to be paid back at the end of the period. So these 3 things. So these 3 things is actually to take the positions in 3 different games. So okay, I want to take the position in the first game. Say it's a long, and take the short position. Take the short position in the second game. And actually, the authors explains the very Mm, this is the terminology that usually the bankers use, but we don't worry about the what do you mean by the leveraged hedge. It's just a name. So from what from my interpretation, these three is just take the positions. And then you can think of this position from the cash flow point of view. So the table one. So let's take a look at the table one, and we are going to interpret each number one by one. So on the left most column, so the first one is write 3 call and buy 2 shares and borrow. So these are the three positions we are going to make. And then on the right hand side, this column is the present date. So this is the cash flow at present day, and then expiration date means it's 1 point time later. And then since we are tossing a coin, it can be either downside or either upside, and depending on which state we are in, the cash flow will be different. So let's just look at the first one, the present value. So write 3 calls. The price of a call option, which is unknown right now, is just a C. And if I sell 1 call option, then I will get C dollars. But since I'm going to sell 3 of them, the money that I get. So so please think about this money from the cash flow point of view. Later, we are going to use the another point of view, but right now, we just think about it as a cash flow. So since you sell 3 call options, you will get 3C. So that's a positive number. So I take the money and into my pockets. And then I'm going to buy 2 shares, and 1 share, the price of the 1 share is $50, and I'm going to buy 2 of them. Then the total money that I'm going to pay is the $100. Then $100 came out from, it goes from my pocket to the other guys. So from my cash flow point of view, it's negative 100. And then I'm going to borrow a certain amount of money from a bank. So borrowing the money, of course, I have to pay back, but right now I have a income cash flow, so it's $40. So that's the uh, present cash flow value, the present time cash flows. And then on the expiration dates, let's think about when S is equal to 25. So they said it's as a star, and it's basically the same as the ST for our case. And think about how can we settle down each positions. So ST is 25. For the call options, you are in a short position of the call option. And just think about the payoff of the short position of the call option. And the future price in this setting is either $25 or $100. So maybe I can draw a picture. So this is the payoff diagram, and then call options payoff diagram looks like this. And this is for the continuous case, but in our example, this is 50, which is a strike price. And then in this simple model, the price can be 25 or it can be 100. There are only 2 things happen. And for the down state, you assume that the price is 25. So for this short position of the call option, I don't have to worry about the call option at all because it expires. So I don't have to pay anything to the holder of the call option. So that means it's nothing. Now I'm gonna take the another position for the long for the stocks. And since I bought 2 stocks, but on the expiration date, I'm gonna no matter what, yeah, I'm gonna sell it back. But the price of each stock is $25, and I have 2 of them. So what I get is just $50, 2 times 25. And then here I have to pay back my money to the bank. And I borrowed $40, and the interest rate was 25%. So actually the interest is $10 for $40. So if I add the principal and the interest, that will be total $50. So I have to pay back $50 to the bank. So it's minus 50. And when you add these 3 numbers, the first one is 0, the second one is plus 50, the last one is negative 50. So if you add these 3 numbers, it is 0 basically. So now I know that, okay, on the expiration date, if the down state happens, then my overall cash flow is going to be 0. Now let's think about the up state. The underlying asset goes up to $100, and I have to reset my all positions. So for the first one, I sell 3 calls. And since I pay call options, but in this time, the underlying asset is $100. So for every call option, I have to give $50 to the long position of the call option. So that's why, in this sense, I lost $50 for each option, but I sold 3 of them. So in total, from my pocket, I have to take $150 and give it to the long position of the call option. So that's negative 150. Now I'm gonna take care of my stock, and I have 2 stocks, and each one goes up to $100. And if I sell back, I will get $200 to my pockets. And for the bank, for banks, it doesn't matter whether stock price goes up or goes down. I have to pay back the same amount of money. So that's the meaning of this last column. But again, when you add these 3 numbers, you will get 0. And this is the clue. So at the beginning, you set up a certain portfolio, and at the end of the period, whether it goes up or it goes down, you don't have to pay anything. Then, since we assume that there is no arbitrage opportunities, then that means the current value, the cost of building the current portfolio should be 0. So that means 3C, here is the equation. 3C minus 100 plus 40 should be 0. Otherwise, there is an arbitrage opportunities. But this is just a simple equation for the C. So once you solve this equation for C, the price should be $20. And that's the answer. So it's just and then there is some more explanations. If the call were not priced in 20, so if the no arbitrage price is $20, but what if the price were $25? Then just do it. So because it should be $20, the one call option should be $20, but it's $25. Oh, okay, that's great because it's expensive. It's higher than the expected value, higher than not the expected value, higher than the no arbitrage value. Then you are going to sell. So actually, yeah, this portfolio sells 3 call option. So actually it gives you, so when you plug in $20 here, the first one is going to be, for the 20 it's 0, but if you plug in 25 here, then it's a 75 and minus 1 is 20, negative 25, and it will gives you $15 in your pocket. So once at the present time, you will get $15 in your pocket, and at the end of the period, you don't have to pay nothing. That's the arbitrage. So the 25 cannot be the no arbitrage value. And then it also explains that what if the price is less than the equilibrium value, then you have to take the opposite position. So you have to buy the option, not sell the option, buy the option and short 2 shares and then invest money. Then you will get the profit also. So it's just the explanation of how to make the arbitrage if the price is not in the no arbitrage price. And there is, they explain something, and here is one thing. So what's maybe, okay, I'm gonna read from here. What may seem more incredible is what we do not need to know among the other. We do not need to know the probability that the stock price will rise or fall. So I did not say anything about the probabilities. I just said the coin shows up head or coin shows you a tail, but it doesn't matter. So whether it's a half or whatever probability, the price must be the same. So that's the end of section 2. And now I'm going to wait your questions. Okay, we already have a question. Explain one more about the first rule of the table, right? 3/4. Okay. Okay, I'm gonna explain. I think I can explain these two together. So why we should pay 150 for selling 3 calls on the expiration date. And this is the what do you mean by 3 calls? Okay. So we it's $50. That's 125. It's for the stock. And there is a call option. And for the call options, and there are 2 people involved. So one is in the long side, and the other one is a short side. And you know what means by long and short. The long side people gives money to the short side people, and that money is C. And the amount of money is the price we are going to find. And then in the paper, it says write 3 calls. And it means actually it's a take a short position in 3 calls. So short position. So since we take the short position, we can get money from the long position people. And each one is $3. So from the cash flow point of view, I can get 3 times C. And it turns out to be the C is 25, later. But at the beginning, we do not know this value. But, well, let's suppose it's $25. Then you sell the options, sell the call option, and then receive $75 in total. And then since you sell something, actually you sell the right to buy. So you sell the right to buy. So this guy has the right to buy. So right to buy what? Right to buy the underlying asset, which is this stock at the end of the period, at the price of 50 for each one. And he has three of this right because you sold the three call options. So at the end of the period, the price can be either 100 or 25 $100 or $25 for the underlying assets. And just think about it's easy to think about the long position side. And once you understand how much long position side will get, then that amount of money is you have to pay to him or her. So what we have done first is, okay, what if the stock price is 25? And if you are in a long position, then you will get this amount of money, 25 minus 50 times 0, which is 0. So if you're in a long position side, then you will get 0. That means when you are in a short position, you owe $0. So that's why we have 0 here for the $25. And then if you are in a long side, then stock price is $100, but you have the right to this 100 worth stock by just paying $50. So for each one in the long position, you have $50 profit. That means if you are in a short position, you have to pay $50 to him for each stock. And then since you sold three core options, you have to give him $150. So that's why the value here is negative 150. Or you may think that, okay, so that's the, you may think that, yeah, why should I give him $50? But actually, you do not give him $50 in the real sense because uh, it's $100 and $25, and you are in a short position, and there is a long position guy, and he has a right to buy $100 worth stock with the price of 50. And you have to, and actually that right is a right to you. So you have to sell in this way to the your stock in $50. But when you are in a short position, you don't have this stock. So you just buy $100 stock and then sell him at $50. So that means for each one you are losing $50 because this one is higher than the. So this is the in the upstate. This is the real price, and you promise to pay. You promise you gives him a right to buy the share at the price of 50. So when he exercises his right, and you have to buy this thing and then give it back to the long positions. I hope you can understand. And if you don't, then just ask me some more. Okay, Mark has answered. And what else? Okay, why should he pay 150 for selling 3 shares? Yeah. This is what I explained. So I hope you understand it.